and welcome. You're watching the Business Today show with me, Sakshi Batra. First up, the top news we're tracking for you tonight. RBI keeps repo rate unchanged at 6.5% for the fourth consecutive policy, but red flags volatility in food and fuel prices. Also removes additional CRR requirements for banks, leading to speculation that FD rates may fall soon. 12,000 crore rupees worth of 2,000 rupee notes still to be returned to banks as deadline ends tomorrow. RBI says leftovers can be exchanged at 19 special counters from next week. Markets extends gains for the second straight day. Sensex closes 364 points higher, while the Nifty is up 108 points. Investors earn 2 lakh crore rupees in today's gains. Almost all sectors in the green. TCS board to consider share buyback proposal this Wednesday. If approved, it will be the company's 5th buyback. TCS had last year brought back shares worth 180 billion rupees. Flying gets costlier as the country's largest airline, Indigo, brings back the fuel surcharge. Every ticket is priced here by up to 1,000 rupees depending on the distance flown. Stock is up 6% in the last 2 days. Straight on to the top story then tonight. The Reserve Bank of India is paddling up for a long innings against its enemy number one, that's inflation. Though the central bank has decided against hiking interest rates for the 4th time in a row, it has retained its hawkish stance. The biggest concern, the RBI says, is the risk of food and fuel prices rising again, especially with an uneven monsoon. The RBI, however, sees some silver lining in the clouds on the horizon.
This is the monetary policy statement for the month of October.
Even the RBI governor has been bitten by the ICC World Cup bug.
It's a turning pitch and we will play our shots very carefully.
He was speaking about liquidity, but the caution dominated the central bank governor's entire statement. Though the RBI decided to keep repo rate unchanged at this year's February level of 6.5%, but it is clear that price rise still remains its top concern. This year's inflation projection has been left unchanged at 5.4%, with estimates of July to September raised to 6.4% and for this quarter lowered by 10 basis points. According to the latest RBI estimates, CPI inflation, which clocked in at 6.8% in August, is likely to ease this month. However, it added that the food prices shocks and the El Nino could yet drive up the crucial economic indicator.
For Kharif crops, the area sown under pulses is below the level a year ago. Kharif onion production also needs to be watched closely. Demand-supply mismatches in spices are likely to keep these prices at elevated levels. The inflation trajectory will also be shaped by the El Nino conditions and global food and energy prices.
There are other factors keeping the RBI governor on his toes. Repo rate has been hiked by a massive 250 basis point over the past 2 years, but its transmission to bank, lending and deposit rates still remains incomplete. According to the RBI, the global economy is also slowing under tight financial conditions, and as a result, global trade is contracting. This led to merchandise exports falling in August as well. The net FDI into India also fell by 64% in April to July to $5.8 billion. Among the silver lining highlighted by the governor, continued resilience in economic activity, sustained momentum in agriculture sector, extended recovery in the industrial sector, strong construction and manufacturing numbers, strong investments driven by government capex, a healthy rise in capacity utilization and, importantly, signs of revival in rural demand. And this has led to the RBI maintaining this year's GDP growth estimate at 6.5%.
The policy mix that we have pursued during the recent years of multiple and unparalleled shocks has fostered macroeconomic and financial stability. The external sector also remains eminently manageable. The twin balance sheet stress that was encountered a decade ago has now been replaced by a twin balance sheet advantage with healthier balance sheets of both banks and corporates. India is poised to become the new growth engine of the world.
The RBI has made it clear that the high interest rate regime is here to stay. 5 of the 6 RBI interest rate committee members voted to keep the stance hawkish, and Governor Shaktikanta Das has said that rate hikes are still incomplete. Bureau Report, Business Today Television.
How do these RBI moves impact the Aam Aadmi and the Indian industry? Business Today Television's managing editor Siddharth Zarabi spoke to CRISIL's DK Joshi and Abhik Barua, the chief economist at HDFC Bank, earlier today. And here's a chunk of that conversation.
Analogy of cricket being used to describe what the RBI is trying to do, and clearly a turning pitch, and the governor saying that they will play their shots carefully. In your assessment, how did the MPC and the RBI come out and bat today?
Well, I think the metaphor was appropriate. I think at this stage, you don't need to, hit a sixer. You just need to play cleanly on the front foot and just indicate to your opponents, I'm sorry, I'm stretching the metaphor, but indicate to your opponents that you're ready to sort of hit anything that sort of comes your way, which is unexpected. So apart from inflation risks, I think there was a lot of emphasis on financial stability as one of the sort of the googlies that could come the RBI's way. And the RBI is saying that, look, we are well padded up. We have our instruments in place, and we will, address both the issue of inflation were it to spike up again.
The googly that Abhik referred to, according to you, is the googly really the one that's likely to come from overseas? We've seen what's been happening to bond yields. We are also seeing what's happening to crude oil prices. And I say this in the context of domestic inflation now perhaps not as major a concern as it was 2 or 3 months ago.
Well, I think the first googly came from vegetables, the tomato, I think, which spiked the overall inflation to 7.4% in July. That's how the quarter started. And then I think the vegetable prices are volatile. We know they correct also because crops have a very short cycle, and vegetable prices have already come down. Actually, tomato prices have been crushed to a great extent. So that fear was gone. And then suddenly the oil prices started rising, and which have been extremely volatile. So the central bank, and not because the global growth is very strong, I think it's largely because of the geopolitics and supply cuts, etc. So that will remain a risk even if the global economy slows down. I think the risk of oil always remains with us.
How significant is this revival in a rural demand, just to pick up one of those silver linings that were mentioned?
Right. I think for a while, I think for most of last year and the earlier part of this year, rural demand seemed subdued. It could have been due to a number of factors. I think the second wave of COVID really hit the rural sector very hard. And you must recognize that the rural sector is not just agriculture. It has a lot of micro and small enterprises there, which are particularly affected by COVID, since household balance sheets. So the owner of a small company, he had to spend a lot on his medical expenses. So that left him with very little to actually sort of keep the business running. So there were huge problems, and I'm not going to go into all the details. But suffice to say that the rural economy wasn't doing well. I think from the second quarter of this year, we've seen a pickup in rural expenditures.
The Reserve Bank of India has said that 2,000 rupee currency notes can be exchanged or deposited at the 19 RBI offices up to a limit of 20,000 rupees at a time. The banking regulator had earlier extended the deadline to exchange these banknotes till tomorrow. After this date, the central bank has reiterated that 2,000 rupee notes will continue to remain legal tender.
Thereafter, it can be, deposited in the or exchanged in the Reserve Bank. In the what you call in the issue offices of the Reserve Bank, which is there in almost every state capital we have presence. So there are 19 of them. So it can be exchanged or deposited in the Reserve Bank issue offices. There is also the facility of sending these, these 2,000 notes through the postal department to the Reserve Bank, because supposing you are away from the state headquarters and you cannot travel, you can send it. So the facility continues with the Reserve Bank. Bulk of it, as you have seen, has come back. So it has largely met our original objective of, withdrawal of 2,000 rupee notes. The process now is with the banks till tomorrow, and then thereafter with the issue offices.
The RBI governor also had a warning in his nearly 32-minute policy statement address this morning. This warning had to do with the high growth in personal loans. These loans are traditionally unsecured and leave banks open to NPAs.
Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The need of the hour is robust risk management and stronger underwriting standards. The global financial landscape is rapidly changing, and potential stress may emerge from unanticipated corners.
The big question being asked after the latest RBI policy is what happens to the interest rates on fixed deposits, which are currently at multi-year highs. Will the rates fall, making FDs less attractive, or should you hope for higher rates in the future? Or should you hedge your returns by booking longer duration fixed deposits?
After years of low returns, bank fixed deposits are in the contention again. Interest rates of FDs have shot up in the past 1 year thanks to RBI's war against price rise. Repo rates skyrocketed 250 basis points in a span of just 9 months. The fastest pace ever at which money became costlier. However, the era of interest rate hikes seems to be over for now, minimizing prospects of FD rates rising further.
Taking into account the evolving inflation growth dynamics and the cumulative policy repo rate hike of 250 basis points, which is still working through the economy, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC.
What the RBI has also done is remove a provision under which banks parked 10% of their deposits with the RBI. This was done to suck out excess liquidity of 1.1 lakh crore rupees from the banking system as a tool against high inflation. With inflation seen at a more comfortable level of 5.4% this fiscal, the cash provision has been removed, leaving banks flush with cash. Deposits of 2,000 rupee currency notes has also boosted liquidity in the market, giving banks little reason to offer higher interest rates to attract more deposits, leading many to believe that the interest rates have hit their peak. But will banks now resort to interest rate cuts? Several banks have already started reducing interest rates of fixed deposits. HDFC Bank recently lowered interest rates on 2 special FD schemes. Axis Bank, Punjab National Bank, Union Bank of India, DCB Bank and IndusInd Bank have also cut FD rate. However, there is little chance of a steep fall in fixed deposit rates. But analysts are suggesting that those looking for the safety of fixed deposit instruments opt for longer tenure FDs, which will ensure higher interest rates for now. Bureau Report, Business Today Television.
Well, stock markets today extended their gains for the second straight session, with investors cheering the RBI decision to hold the interest rates. Buying was seen across major sectors, supporting the sentiments on the Dalal Strait. For the day, BSE Sensex jumped 364 points to settle the day at 65,996. The Nifty, on the other hand, jumped about 108 points to end the day at 19,660. The top Nifty gainers were Bajaj Finserv, Bajaj Finance, Titan, IndusInd Bank and Tata Consumer. Meanwhile, the top laggards included names such as HUL, Coal India, ONGC, Asian Paints and Bharti Airtel. A decision can be taken on exempting millets from GST as early as tomorrow. The GST Council, in its 52nd meeting tomorrow, is likely to review the implementation of the 28% levy on online gaming, horse racing and casinos, as well as look into the pending proposals for rate restructuring in items including millets and the setting up of the GST appellate tribunals as well. According to sources, the GST Council, chaired by Finance Minister Nirmala Sitharaman, is likely to approve exempting millet-based food products from GST. The move is significant given the government's focus on popularizing millets as well. The council is also likely to review the GST rate for batteries of electric vehicles that are currently taxed at 18%. The country's largest airline has also made flying costlier now, a move which has pushed up its share prices 6% in 2 days. Indigo is charging a distance-based fuel surcharge on all tickets starting today. The fuel charge will be based on distance slabs and will vary between 300 and 1,000 rupees per sector. The decision has been taken after prices of aviation fuel were hiked by more than 5% this month to 1.18 lakh rupees per kilolitre. And this was the fourth consecutive hike in aviation fuel prices, which comprises nearly 40% of the airline's operating costs. Other airlines have not yet added this surcharge to their ticket prices. And housing sales are on a rise right ahead of the peak festive season, indicating improving demand, even as residential sales in the third quarter of 2023 jumped by 36% in India's top 7 cities. The outlook for the entire year is even more positive. I earlier spoke to Anuj Puri, chairman of Anarock Group, who has now projected residential sales to reach a 15-year high this year. We are looking at the peak festive season coming ahead. Do you believe this performance can be repeated in the next quarter as well? And compared to the pre-COVID period, which you mentioned that 1.65 lakh units were sold in a year, at least are we looking at overcoming that, shooting that, and going beyond the pre-COVID levels?
So certainly we will go beyond the pre-COVID levels, actually. So it was 1.65 lakh units a year before COVID. We will be touching about 5 lakh units this year. So, it is like 2.5 times of that. So certainly that is there.
How many years high would that be? How many years high would that 5 lakh units be then?
From memory, I can tell you is the last that I had seen was 2008.
Wow. Okay.
So you're really talking, pretty high. And that also 2008 was a little artificial, Sakshi. I don't know how much time we have, but really it wasn't genuine because it was all speculator-led and it was largely NCR, which was quite artificial at that time. This 500,000 is real end-user solid demand. And then finally, to answer the other question that you asked is, I'm hoping that this trend continues. Over the next few quarters. Again, I say is that I don't see any reason why the trend will not continue given the solidity of the economy, the Indian real estate, the pedigreed player, the consolidations that has taken place, and the genuine demand that is coming in from the home buyers.
Well, many thanks for joining us on this special edition. It's a wrap from us, but do stay tuned on to India Today to catch all the updates from the world of general news.